This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, we had some pretty promising trading this week in gold and silver, Eric. Gold is back above resistance at the 1320 to 1330 level. Strong move in Thursday's London session up through 1300. It actually closed in on 1350 before consolidating the second half of Thursday and into New York trading, as well as Friday really consolidated as well around the 1335 level. And in silver, we also had a big move Thursday during London trading. Silver moving strongly up off of 21 through 2150 at one point before consolidating right around the 2140 to 2150 level to close the week out here on Friday. So really haven't seen much of a pullback at all from big move higher from, what was it, about 1850-19 in silver and as well in gold. So we've really seen a healthy consolidation here.
Yes, we have. It's interesting that, yesterday metals were performing really well right out of the comics open, and to a large extent, actually, in the very shortest of terms, reflecting the fear of a deflation crash in a banking system in Europe with problems in Portugal banking sector in particular. Yesterday, gold and silver took off like it's called the cat on the open, but then gold started getting pressure from the cartel trying to keep things under the 1% rule, and it's really fascinating to watch over the last 7 to 10 years. It's been uncanny the number of times that the amount of upside that's allowed to happen on a closing day basis, a 24-hour period, in gold in particular, is usually capped at a 1% upside gain or a 2% gain or so forth. I mean, you can literally mark your calendar on these instances in which that kind of accuracy in the capping comes in. It's just astounding. But the point being is that silver actually was able to resist that and did not come back down as much and kept most of its gain yesterday. So that's pretty encouraging. We've seen a steady accumulation over the course of the last few weeks and periods of consolidation, but absolutely no ability by the cartel to get prices moving to the downside, even though there have been a couple of days when big moves in a spike fashion came in, showing their footprints, but by the end of the day, or by no later than the next day, trading had firmed up, and we at worst went horizontal. And that's the story of the last 2 weeks. It really is the take-home point to be made. It reflects the change in the character of the market that we've seen since June 1st. And we are definitely in a new upsurge move in this latest bull cycle after many months of the water torture of testing 19 and sometimes even testing 18 in silver and going all the way down to 1160 or something in gold a couple of times over the 2013 period. So I still believe that we're going to test $25 in silver as but one example this month. And it's going to surprise people. We're still in the summer doldrums by most people's estimation, and most people have the market's temperature wrong.
Well, Eric, the other big news to come out this week, really today, Friday, in the gold and silver market, is the report that the CME, along with Thompson-Reuters, have been hand-selected to replace the London silver fix, an electronic fix, beginning in August when the London silver fix ends. So I know, Eric, you and I have discussed for a long time that the end of the London fix doesn't necessarily mean the end of silver manipulation, like a lot of those in the alternative precious metal sphere have excitedly been yelling since the news was first released several months ago that the London fix would end in August, and they came to the immediate conclusion that the silver manipulation would be over in August. So that certainly, we didn't believe it would be the case at the time, and I think anyone who thought it would be the case now can certainly agree that with CME and Thomson-Reuters taking over an electronic fix, you're probably not going to see too much of a change for what we've seen in the silver market. I think it's probably a change for the better with it being an electronic fix, but certainly with the CME being the oversight of the fix, it's not too much of a change from the LBMA.
Yeah. I was thinking that, in the very least, we could hope that this would be a move more in a transparency direction because it's based on electronic trading and the prices would be out on the exchanges, and that whatever the fixing of the end of the day, and presumably there would also be an AM fix too. I don't know, but certainly a PM fix. And if that's predicated on just the trading during the course of the day. That would presumably be more transparent, but it is the CME, or rather the LBMA, and not more needs to be said on that. But in any event, the bottom line is that this isn't really going to be just a small footnote in the whole tale of the unraveling of the cartel's ability to manipulate the markets. They made pennies here and there using this fixing system and its manipulation, but the real big tools for market management and manipulation of the silver and gold price have always been the liberation of physical from vaults and the dumping of monstrous amounts of contracts in short periods of time, particularly when volume is low, and that dumping would basically run their stops and break down the market for short periods of time. That's where the power is for the cartel to manipulate the markets, and the silver fix now finding a new home really isn't going to mean much of anything when it comes to the long run.
Right. Getting back to the Eurozone banking fears here for a minute, Eric. We've had deflation fears really over the last couple of weeks. We were just chatting before the show. Oil's been down over the last week to 10 days. And I want to get your thoughts with the risk of Portugal's Banco, Espirito, Santo. What's your thoughts on the risk of a bail-in returning to the Eurozone? Just this past week, we had the German cabinet resolve to put forward necessary legislation early in 2015 that large German deposits will be subject to bail-ins if any bank fails. So as Dieselboom tried to put out in the wake of the Cyprus bail-in that it was a one-off event and it wasn't their plans. I guess he said that after he attempted to retract his initial admission. It certainly looks like the Eurozone's plans are for bail-ins to try to contain any banking crises. So what's your thoughts? Are we going to see that in the near future in Europe again, perhaps with Banco Espirito?
Well, what's interesting about this? I think we need to zoom up 50,000 feet and take a bigger picture look, because I've always found these bail-in models to be a little bit strange, because, frankly, if we have a derivatives crash that has counterparty risks, basically undermining institutions left and right across the financial sector, there's no way in heck that a bail-in model can stop that. There's not enough money under deposits to deal with the counterparty crash of a systemic proportion. If it takes down 10% or maybe even less of the European banking system, that exceeds the amount that's on deposit in the European banking system. So this whole model for addressing these insolvency problems, and that's essentially what we're talking about, doesn't make a lot of sense unless if it's basically a strategy analogous to being able to pull a Band-Aid out and sticking it on a single institution. And in fact, I'd even argue, particularly with some of these larger institutions, that the problem has to be relatively small, not an insolvency of 10x times their capital. So, it almost, if that assumption is what we would use as a working basis for understanding the situation, then you have to assume that the regulators, once they see a bank that's imploded because of its insolvency, would have to be thinking something along the lines of, well, if we're going to bail in, that's going to scare everybody in Europe. Do we want to pull that lever just now? Because if the act of actually doing a bail-in and confiscating of deposits in a bank that's not in a small place like Cyprus, where there aren't a lot of regular people in Europe in the banking system having their monies there, runs the risk of actually compounding the problem. And it's almost like you're ringing the bell and saying, hey, guess what? There's a problem here. Everybody pay attention to it. So it's even hard for me to speculate as to what the regulators will do. They're even relying on a bail-in strategy in and of itself is just foolish, but that's apparently what they're going to want to do on a case-by-case basis, and it's a question of whether or not they want to run the risk of sounding the alarm that the financial system has lots and lots of problems across many institutions by bailing out one bank by going after depositors. So to answer your question, I don't know. I think that they will be hesitant to actually go after depositors in a mainstream Portugal bank, because that's going to send smoke signals to the rest of Europe and scare a lot of people. So I think it's kind of something we'll just have to wait and see what happens if the bank needs to be bailed out, whether or not they'll go after maybe a hybrid strategy. I'm not really sure. And when I say hybrid, I don't mean strictly a balance between ECB funds and credits to bolster the position of the bank and depositors, but maybe they'll go after the bondholders too and do some kind of a mix. I suspect that that's the most likely outcome, that they'll do some kind of a mix when it comes to whatever is the next bank that goes bust, and that they'll try to deal with it as opposed in an isolated way, rather than trying to go after just the depositors and create the fear of bank runs running across the European banking zone. So, time will tell. But the bottom line, regardless of what the regulators do and the powers that be do to try to address the situation, the fact remains that many banks in Europe are insolvent, and that assets that are bad are being hidden on balance sheets, and that in order to address these problems, the main tool will continue to be the pumping in of liquidity into the system to keep everything afloat. And that, in turn, is going to continue to debase the purchasing power of the euro. And by extension, we have similar problems in the United States, and it's kind of a race to a bottom. It doesn't show up so much in the pricing of the comparative values of currencies in their exchange directly with each other, but in terms of their purchasing power, just because the euro and the dollar have the same exchange rate in any given month, for example, doesn't mean that you'll be able to buy as much goods and services with either currency on either continent in the same given or at the end of that given month. And this whole devaluation of currencies continues. And that's something above and beyond the known issue of just the systemic risk of our financial system teetering. And one other interesting thing is that it seems that more and more people are beginning to recognize that 2008 was the opening act. There's not a lot of this in the mainstream press, but you can see it every once in a while being discussed that, hey, nothing was fixed in 2008. We still have a lot of the same problems. And there's this kind of hushed talk on the street, so to speak, people under their breath talking about the derivatives bomb that's out there that has not been addressed. It's all the more reason to continue to expect gold and silver to perform well as hedge assets, as security assets.
And just so listeners understand Eric's point of why bail-ins are unable to stop a derivatives crisis, if we considered, or if they even took and bailed in the entire depositor asset base in the world, we're talking two-digit trillion number versus the derivatives outstanding are over 1 quadrillion, so several orders of magnitude larger. That would just simply wipe out the deposits if you had a full-blown derivatives crisis raging. So
and if you look at an institution like Bank of America as but one example, I think their derivative position like $54 trillion or something like that. I know it's above $50 trillion. And that's like 5 times the gross domestic product of the United States. And it's just so massive that if you have a systemic crash where counterparties begin to fall and then they just accelerate like dominoes because everybody else is doing everybody else's risk laundry, there's no way that depositors' money can stop that catastrophe. And it's just a sick joke that the regulators have put in the bail-in model as a way of trying to appease the markets and calm fears. It can't work. It's a math problem, not an opinion. This is something that, if were we to have the black swan of all black swans creating a derivatives systemic crash, nothing can stop it. Nothing can fix it. It would just have to. Basically, we'd have a bank holiday, a jubilee of certain amounts of debt, and an entire reset of the global financial system. That's the only thing that can fix a systemic crash. And hopefully we won't have a systemic crash, because the likes of the Great Depression would pale in comparison to the kind of disaster that would result with the mountain of paper that we've created thus far. And it remains to be seen whether or not we can skirt that, but I suspect that in the very least we're going to have some kind of a day of reckoning that deals with at least part of this bad debt. And then hopefully won't create an entire systemic crash, and that the powers that be will be able to manage it to some extent. But their track
kind of
record
touching
is
on
not
that.
good.
Kind of touching on that, Eric, nobody really talks about it in modern finance and economics. I recall Ben Davies actually wrote an analysis on it maybe 4 or 5 years back. I think it was titled "There Is No Jubilee." But from a long-term perspective, that is one of the aspects of why we have these credit cycles and bubbles and crashes, because there is no jubilee that was prescribed. So that's kind of an in-depth topic that we don't have time for, but it's something that's not discussed at all.
As a footnote, it's worthwhile to point out that theoretically you wouldn't need a jubilee if you didn't have the excesses of a credit system gone wild, and with our modern world of credit creation at the speed of light, we certainly, as the human race, has perfected the ability to make mountains of fiat and credit so unstable beyond anything of the wildest dreams of the earliest periods where humankind did jubilees to relieve debt pressures and whatnot. I mean, we have a misallocation of capital at the grandest scale ever known in human history right now, and it ain't pretty.
Well, let's shift gears a little bit here and give the listeners a quick update on the status of the physical market here in the U.S. I know all our regular listeners look forward to that, and we really haven't seen much change over the last week or two on the physical side. Retail investment products here in the U.S., everything is pretty much readily available. Coins are available, whether they're government coins, private mint coins, and even the 90% coins, and even 90% half dollars can be found now. That's the first time in quite a while. Just a month or two ago, bags of half dollars were selling at a few of the more well-known, larger online dealers for just about $4 over spot. And so premiums have come down nicely as a bit of supply has come back into the market, with prices moving up in the 90%. And even the private mint products that had been on 2-4 week delays early in the year, they're now readily available. And premiums remain low across the board. So it continues, in my opinion, to be an excellent time to add or accumulate metals here, particularly if Eric's prediction is right, and that silver will test 25 by the end of the month.
Even if I'm wrong, I mean, longer term, and even just in the intermediate term, 6 months and beyond, the prices will most likely go up. And it's interesting too. A lot of people say, hey, when the silver market's going down and there's an ample supply in the retail chain, they say to analysts like myself and letter writers and so forth, what's the story here? We have a mismatch in terms of premiums being small and great availability, and your guys are making a case that prices are going to go higher. And this actually is another example that isn't frequently noted, but is nonetheless important to note, that it's a disconnection between the physical market and the paper market. And what we see right now in the last, basically since June 1st, the paper market and the cartel's ability to push the paper market around lower, basically ran its course, because they have depleted inventories in vaults, and the pricing that happens when they dump futures contracts excessively to push prices down only ramps up demand in Asia and whatnot. So there's a limitation to how far they can push paper prices lower. And when you compare that to the physical market, even though the physical market shows that basically the American or North American buyer is just kind of lapping around the edges, maybe picking up some discounts once we bottom off of 18 and move back over 19 in silver, people say, I want to buy some. They won't be brave enough to buy at 18. They'll buy at 19.25 and higher and begin to purchase more. But there's still all this slack here in the physical market, and we get a lot of people in our message posts after we post articles and whatnot saying, well, hey, come on, what's the deal? Why is all of this slack present in the market, and we see the premiums low and ample supply from U.S. Mint, et cetera? And that's the reason why. It's the physical difference, the physical market's difference between the paper markets. And it can't be stressed enough that the cartel just can't push prices down much lower than that in 19 area in silver and $1,250 gold, give or take $10. And here we are. The downside risk is defined by those levels, and we're talking about dollars to the downside and tens, if not hundreds of dollars to the upside for gold, certainly, and maybe even silver in the next year or so.
All right, so Eric's looking for a big July in silver. That'd be $3.50 move to the upside over the last 3 weeks. So it'll definitely be an exciting second half of July if Eric's outlook plays out, and it certainly wouldn't surprise me with the strong consolidation we've seen over the last couple of weeks, for that to happen. So
yeah, and once we get there, we're going to get hit in the head. I mean, I'm not expecting this to be a huge run without much stopping. We'll get into $24 and change for silver, hit a brick wall at about 25, and we might fall back down to even as much as 22 or whatever in the next subsequent 60 days or whatever, or more likely 30 days. But for the balance of the year, I think we will test 30. We will exceed 30 most likely. And I know a lot of other people like Eric's product on much higher targets, but suffice it to say, I think that sticking with somewhere in the $30 range is probably pretty doable, given supply and demand trends in the real world for the physical market, not for the paper market.
All right, we'll wrap up this week's show there. So for the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They use the word orderly. As long as it's orderly, it seems to be okay.